Hello. Yeah. Okay. Now, the purpose of this recording here is to review the mock exam of ACCA AFM Advanced Financial Management paper. So, preparing you for this coming December 2025 exam. The length of this video is 2 hours. Is to review the mock exam question that you should have attempted. So if you have not attempted the mock exam, my advice is you stop this video immediately, go and try the mock exam, then only come back. So do not look at this video until you have attempted the mock exam. Now, so as per the exam format for AFM, the exam is divided into 2 sessions. Session A, 50 marks question. Session B, 2 questions, each one 25 marks. So a total of 3 questions to be answered. The 3 questions were drawn from 3 main areas of the syllabus. One on investment appraisal, one on mergers takeover, sometimes divestment, and one on risk management, interest rate risk or currency risk. These are always the 3 focus areas. Okay, so right, I will go straight to review these questions now. Okay, this recording is only 2 hours, therefore unlikely we can do all the 3 questions completely. So I'm going to focus on 2 questions, which I think you need my help to review, which is question 1 and question number 3. Question number 2 are very much financial statements, which I think you can just go through by yourself with the suggested answer given. Okay, now I'm going to start with question number 1. This is the compulsory question. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Malvern Company expansion plan, financial details of the projects follow on option. This information should be used to answer the questions. Requirement within your chosen response options. So the response options are word processing and spreadsheets. Theoretical questions should be answered in word processing. All your computation should go into the spreadsheets and use the spreadsheets functions as much as you can. But not the very basic calculation. You can actually do it by yourself, most of the calculation, but a function like MPV, IRR, summation, all that you can use spreadsheets because this is part of your communication skill. Okay, Exhibit 1. Malvern is a manufacturing company of manufacturer of vacuum cleaner. It is based in United States of America, where the functional currency is US dollar. So US dollar is the home currency. The directors have decided to expand into South America by undertaking a 5-year project, investing in a new manufacturing facilities in Ravania, where the currency is Ravania peso. Ravania economy has grown very quickly over the last decade as the government incentives have encouraged inward investment, particularly in manufacturing and technology sector. Consequently, there are a large number of highly skilled workers in Ravania and many modern manufacturing facilities. Initial market research carried out over the last few months cost 500,000 has revealed there's relatively small market for vacuum cleaners in Ravania at the moment, but the market is expected to grow rapidly over the next few years. Now, research undertaken, already done. So this 500,000 is sunk cost. All past costs are not relevant. Okay, this is happened already. 2 financial details of the projects. Malvern intends to invest 3 million peso to buy a factory in Ravenna, and then another 1 million to buy state-of-art manufacturing machines and equipment. This amount will be paid immediately. Immediately always means time zero. After 5 years, the machines will have realizable value 500,000 peso. The factory will have realizable value 2.8 million peso, all in money terms. In money terms means this figure here already include inflation. Okay. Working capital 0.5 million peso will also be required immediately, times zero. This will be increased by the rate of inflation in Ravenna throughout the projects. So increased by the inflation and will be released in the final year. Sales in Ravenna, so sales unit year 1 to year 5. In year 1, unit selling price for the vacuum cleaner 120 peso. Directors intends to increase the price by 5% each year thereafter. So after year 1, you increase. The unit variable cost in year 1 expected to be 45 peso. Total fixed cost in year 1 is 1.5 million peso. This cost expected to inflate in line with inflation in Ravenna. Okay. Also, the net contribution in the US expected to increase by 0.12 million before tax. In year 1, if Ravenna project goes ahead, as the production in US is modified to incorporate some of the new state-of-art manufacturing method, this annual amount expected to increase over the life of the projects in line with the inflation in US. Corporate tax in Ravenna 15%, tax in the US is 25%. So when the home country tax rate is higher than the foreign country, we have additional tax. Yeah, the difference is the additional tax, 10% here. In both countries, tax is payable in the year the tax liability arises in the same year. Both country tax authorities allow losses to be carried forward and write off against future profit for tax purpose. So you need to carry forward losses. All that we have done in the class. A bilateral tax treaty exists between the two countries. Tax allowable depreciation, capital allowance, available on the machines and equipment at the rate of 20% on the original cost each year. In the year of disposal, a balancing allowance or balancing charge will be claimed. Factory will not be eligible for tax allowable depreciation. Spot exchange rate 2.58 peso per dollar. Inflation 3% per year in US, 6% per year in Ravenna. For the foreseeable future, the cost of capital for the project is 10%. Follow-on product, this is the option, the BSOP model, the real option. So you must use BSOP here. The initial Ravenna investment is only a relative short-term 5-year project. However, the director expects that if the project is successful, it will allow Malvern to explore a follow-on opportunity. Now, real option, we say there are 3 types. Option to delay, option to expand, option to sell. So this one, very obvious, is expand. Yeah, you start with this 5-year project. After that, you can expand a follow-on project. So this one is option to expand. Option to expand is call option. To expand means to buy some more. So option to buy is call. Initial investigation into this follow-on project suggests an investment of $2 million in 4 years' time. would yield overall after-tax return 0.3 million each year in perpetuity from year 5 onwards. The standard deviation of the follow-on project's cash flow is likely to be 30%, and the risk-free rate of return is currently 6%. The business risk associated with the follow-on project is expected to be very similar to the business risk associated with the initial project. So the business risk doesn't change, so no need to adjust that. Okay, prepare a report to the board of directors. Okay, in the class, I've already explained to you the report format. So you got to follow that to get the communication skills marks. At least there are 3 marks there. So I mentioned you must have the format, to from date title, plus your signature at the end of the report, 1 mark. The structure, so that's format, 1 mark. The structure, so your report must have subheading, break out into small paragraph. Okay, report on word processing, or the computation put in the appendix using spreadsheet. That structure, so that's another mark. Then you must have an introduction paragraph highlighting the content of the report. That's another mark. So there are 3 marks there. Okay, so all these I've already explained. So if you have forgotten, please refer back to your lecture. Okay, so a report. 1. Calculate the net present value of the proposed investment in Ravania without considering the follow-on option to invest in the second factory. Show all your calculation. Then calculate the overall value of the projects, including the option. And then you're going to discuss. Right? So that's your first question. Okay. The second part is behavioral aspect. 4 behavioral aspect of finance. Okay, all these you should be able to see from the lecture notes that I've given you there. Okay, then you have professional marks, 10 marks. Okay, so all these professional marks we have mentioned in the lectures. So as I do this question, I will just bring in again. So the first professional marks here will be your communication skill, where your report, you have 3 marks there, and your spreadsheet skills, you have 2 marks there. So that's 5 marks already, easily. Okay. Okay, so I'm going to start with this question now. Okay. So I'll prepare the spreadsheets. Okay, I'm going to use this one here. Okay, now, so therefore, this should be your appendix. Right, this should be your appendix. Okay, so MPV, okay, for the new projects in the country called Ravania. Project in Ravania. Okay. Okay, first we set up the table. Okay, so for this question, the choice between MPV and APV, I told you 2 judgments. There's no mention about subsidized loan here. There's no mention about the project's fully financed by debt. So obviously this is MPV question. So first we set up the table. Okay, we have year 0, 1, 2, 3, 4, 5. Okay, right. The foreign currency is in Ravania peso. Let's put it on 1,000 basis. So we have operating cash flow. Okay. Then we have capital cash flow. Right? 1, 2, 3, 4. Okay. Then we have the net cash flow in LP 1,000. Okay. Now, then convert. So the exchange rate here is given as peso per dollar. Peso per dollar. Yeah? So peso is the first currency, therefore we need to divide. Okay, divide. Yeah? Okay, divide. That will give me the net cash flow in $1,000. Okay. Then you have the home country cash flow. Additional cash flow in dollar. Right? Okay. That will give you the overall net cash flow in dollar now. Okay. Then we put down the discount factor, then we can find the MPV. Yep. Okay. Okay. Just underline it just for presentation neatness. Just underline this. Okay. And of course, we need workings. Okay. Okay, so let's start. Okay, from beginning of the question, first item, sunk cost we don't take. So we start with this capital, 3 million plus 1 million immediately. So capital. Capital, 4 million minus 4 million. Okay, next. Okay. Scrap value 50,000 after 5 years plus 2.8 million. So that will be 2850. Yep. 2850. Okay. Year 5, 2850. Okay. Next. Working capital. 0.5 million immediately, increase in line with the inflation rate in Ravania, which is 6%. Okay, working capital. Okay, this one we need a working, so we put here working number 1. Yeah, working has to be clearly identified. Okay, so your projects, your presentation, your working clearly identified, all these are part of your analysis. Yeah, so it's analysis skill. Okay, so with this proper presentation format, neatly presented, you can get 1 mark there. Okay, so working number 1. Yeah, so the working capital. Start from now. Yep, start from now is $0.5 million. increased by inflation in revenue, which is 6%. Yeah, so this is peso in thousand. So 0.5 million is 500,000. Right, 500,000. Okay, then you have year 1, year 2, year 3, year 4. Okay, every year increased by 6%. So 500,000 times 1.06. Then 530 times 1.06. 562. I just take nearest. 562. Okay, times 1.06 continuously. Okay. So year 5 is the final year, recovered always. Yeah. Okay. Now we need to take the incremental working capital. So outflow 500, then increase 30. Yeah. Then 32. Yes. Then 34. Okay. Followed by 35, outflow 35. Yep. So total working capital taken out should be 631. Okay, 631. So the last year, 631 come back. Okay, put that into the answer. Okay, working capital. Start with outflow 500 minus 30 minus 32 minus 34 minus 35, and then 631 come back. Okay. Okay, working capital done. Next item. Now comes to the sales unit, selling price, and the variable cost. Okay, contribution. So given these three items, selling price, variable cost per unit, and the sales unit, straight away we find contribution. Second working. Okay. So contribution, my second working now. Okay. Oops. Second working, Okay. Okay. Selling price less variable cost per unit, you get contribution per unit, times by the sales units, you get the total contribution. Okay, so the price should be in peso. The total we put on 1,000 basis. Okay, now the selling price is the sales unit first. I put in the sales unit first. So 15,000, 26,000, 15,000, 26,000, 32,000, 35,000, 33,000. The selling price, all the data given is first year, 120 peso. Okay, they say increase by 5%. So the price will increase by 5%. The variable cost will increase by inflation in Ravania, which is 6%. Yep. Okay. Variable cost first year is variable cost 45. Okay. So 120 times 1.05 is 126 times 1.05 is 132.3 times 1.05 138.92 times 1.05 is 145.86. Okay, variable cost 45 times 1.06, 47.76%. Then increase 6% every year. Okay. So I can now get the contribution. So contribution per unit equals selling price minus variable cost. Okay. Then the total contribution is this multiplied by this. But I want to convert to 1,000, so I divide by 1,000. Okay. Okay, and I just got to copy this cell, paste it to the other 4 year. They become very fast. And I copy this cell, paste it to the other 4 year. Okay. And I think I do one decimal. Okay. Done. So this contribution goes to the final answer. I copy this, I copy this, I put into the answer, but I'm going to paste figure. You don't paste the formula, then everything, the formula will come in. So I'm going to paste figure. 1, 2, 3, this one, paste figure. So only the figure will come in. Okay, so you can check. So the formula doesn't copy over, you can check. The formula doesn't copy over. Okay, contribution done. Right, next one. Fixed cost 1.5 million. Okay, fixed cost, put in directly here. 1.5 million in the first year. Okay, this is outflow, so I think to be consistent, I'm going to use minus here. Okay, it's outflow. Increase with the inflation in Ravania, so 6%. Okay, 1,005 times 1.06, 1590 times 1.06, 1685. Okay, next one, 1787. Next one, 1894. Okay, next. So this side finish. Now, contribution in the US will increase by 0.12 million in year 1, increase with the inflation in US, which is 3%. Okay. So the cash flow in the US, you have contribution increase. Okay, contribution increase, which is 0.12 million, so $120,000 in the first year. increase by 3% every year. One, 2, 3.6124, yeah, followed by 127, followed by 131, 127, followed by 135. Okay, next. Okay, that's it, the cash flow done. So after we put in all the cash flow, then we adjust tax. Okay, next we adjust tax. So to adjust tax, we come back to here. Right. Okay, for foreign investment, remember there are 4 aspects on tax. The first one, foreign cash flow first. We find profit and tax payable. Okay. Tax rate in Ravania is 15%. Yeah, so the top part here is the foreign country. Okay, 15% in the same year. Okay, so I get the profit first. So profit is this one plus this one. Yeah, but this is already negative. Okay. Okay, let's go copy, paste. Okay, I do one decimal. Then the tax payable. Now, because losses you are allowed to carry forward. Yeah, so the first year is loss year. So because losses you are allowed to carry forward, then we need to show a working for that. Okay, so that will be working number 3 now. Yeah, working number 3. Okay, so if you can carry forward losses, you got to show it separately. Yeah. Okay, I did the profit. Okay, from here I did the profit. This one, this 5-year profit, copy, put it down here. Yep, paste figure. Okay, make sure you paste figure, otherwise the formula come in, you will have a lot of mistake. You should check. Okay, you click and then you check. Yeah, it's figure. So make sure you double confirm so you don't paste the formula, then all your figures will be wrong. Okay, now you need to bring in the capital allowance. So the capital allowance is on the machine. Machine cost is 1 million. Yeah, 1 million. Okay, now 15%, right? 15%. No, not 15%, 20%. 20% on cost. So it's straight line, 20% on cost. Okay. And then the last year you have balancing allowance or balancing charge. Okay, so therefore, to work out this CA, I'm going to do it down here. Number 4. CA on the machine. Okay. Now, The capital cost is 1 million. 1 million. Okay. Right. That's year 0. The capital allowance from year 1 to year 4, the CA is simply 20% of the cost 1 million. So it's 200,000 every year, right? Per annum. Yep. Therefore, after 4 years, your net book value 200 times 4 years is 800. So 1000 minus 800 is 200 left. Year 5, the last year, you compare with the scrap value, which is the scrap value for the machine is 500,000, 50,000, yeah, the machine, yeah, 50,000. So scrap value is 50,000, okay. Therefore, you have a loss of 150, correct? Loss is called balancing allowance. Yep, BA, balancing allowance. Okay. Okay, now. So apply the tax rate of 15% in revenue. So you can then get the tax relief. So 200 times by 15% is 30 every year. Year 1 to year 4. Okay. Year 5, 150 times by 15% is 22.5. Okay. That's all. Yeah. So year 1 to year 4 is 30. Tax relief of 30. Yep, you minus this 30. Okay. I think if you want, you can put negative here. Right, negative here. Awesome. Copy. Okay, so your taxable profit year 5 is 22.5, 22.5 or 23. Okay, so now your taxable profit first year don't have. Okay, second year 416, third year 901. Okay, followed by 1169, followed by 1022.5 or 1023. Okay, if you want, you can keep it to no decimal. Yes. Okay. Okay. So therefore, okay, we can now work out the tax payment. I have to insert one more column here. Insert one row here. Okay. Okay, the tax payable tax rate is 15%, right? Okay. Oh, hang on. Mistake. Wait, I don't calculate the tax. I apply the tax at the bottom here. So I don't apply the tax here. Like mistake. Because if we put in the answer directly, we apply tax rate. Here we cannot. Because I just put in the CA to find the taxable profit. So this is wrong. So this should be minus 200. Yeah. Every year minus 200. We are finding the tax rate 15% at the bottom, so we should not put down the tax relief here. This one should be minus 150. Okay. So all these I got to change. Okay, I use formula. Equals to this one plus this one. Okay, then I copy, I paste. Yep, this should be capital allowance. I apply the tax rate here. I apply 15% here. Okay, now first, because these losses will be carried forward to write off here. Yep. So 246 you will carry forward to write off here. So this year will not have taxable profit as well. Okay. The balance you will carry forward and write off here. So the balance is how much? 575 minus 246 is 329. 329 you carry forward here and write off here. So minus 329. Okay. Minus 329. So your taxable profit becomes 731 minus 329. It becomes 402. 402. Got it? Okay, so these losses, okay, first year 575 losses, 246 write off from year 2. So year 2 there's no more taxable profit. Balance 329 write off from year 3. So 731 minus 329 is 402. Okay, 402. So this become your taxable profit. Yeah. So therefore, okay, what I do is to make it look better. I take out this, yeah. So first year is new, okay. Okay, I just draw a line here, and then this one I just bring down 99. This one I just bring down. Okay, it look better, yeah. Okay, so then tax as 15%, nothing here, nothing here. 402 times by 15% is 60. 999 times 15% is 150. 895 times 15% is 134. Okay. The profit multiplied by 15%. Yep. Okay, we put in this tax payment into the answer now. So 60, 150, 134. Okay. Starting from here. Minus 60. Minus 150 minus 134. Okay. Okay, tax payment. Yep. Okay, so tax done, capital allowance done. Okay, if there's no carry forward, we put in our capital allowance here. Since there's carry forward, we already net off here. Yeah. Okay. So tax done, capital allowance done. Number 3. Tax in the home country. Home country tax rate is 25%. Yep. So I would take this contribution multiply by 0.25, 25%. And it should become a payment. So I just put a negative here. Okay, it should become payment. And just copy this. Paste to the other 4 year, right? Okay, to 1 decimal. Okay. Okay, now finally, additional tax. additional tax of 10%. Because the home country tax rate is 25%, foreign is 15%. So we have additional tax 10%. Yeah. Okay, additional tax 10%. Okay, this one we need to show working. So this should be working number 4 now, I think. Working number 4. Working number 5, right? Working number 5. Okay, additional tax, working number 5. So how to get this extra 10%? Okay, I will take this profit. Yep, I must pay extra 10%. So multiply by 0.1. Okay, and then I will need the exchange rate. Yeah, so I haven't got the exchange rate yet, so I'm going to take out this percent. Okay. I will need the exchange rate first. So okay, I'm going to do the exchange rate here. Okay, the future exchange rate. We got to forecast the future exchange rate. Using purchasing power parity theory, PPPT. Yep, using purchasing power parity theory. Okay, peso per dollar. Okay, peso per dollar. Now, the spot rate now is 2.58. Yep, the spot rate now is 2.58. Okay, so the first year rate is the spot rate now multiplied by 1 plus the inflation rate. So this is peso per dollar. So peso inflation on top 6%, dollar inflation below 3%. Is peso per dollar. Yeah, so it's 6% and 3%. Okay, so that will give me 2.66 first year, 2.66, right? Then when it comes to a second year is 2.66 multiplied by 1.06 divide 1.03. That will give me 2.73. Okay, then the next one will be 2.73 times 1.06 divide 1.03 continuously until you come to the last year. That's 2.81. Yep, continuously. $2.98. Yep. There's no need to show the one in red color, just for class purpose. So I will take out the one in red color now. Okay. So the additional tax now. Okay, the additional tax start first 2 year don't have, so it only start from year 3. This should be year 3, year 4, and year 5. Okay. Okay, year 3 is this profit, right? This profit multiplied by 10% or 0.1. Okay, that will give you additional tax in peso. This tax is paid in US, so you have to be in dollar. Yeah. So the exchange rate is peso per dollar. So peso is the first currency, so we divide. Yeah, divide by year 3, so it's this one. Right, year 3. Okay, so you get that. Yep. So that's your additional tax. Okay, this is in $1,000. Right? Now, then year 4 will be this one multiplied by 10% divided by year 4 exchange rate. Yep. This one will be year 5 profit multiplied by 0.1 divided by year 5 exchange rate. Okay, yeah, and I don't want decimal. $14.35.30. Okay, first 2 year don't have. $14.35.30. Okay, so this one the formula is here. Okay, done. So there are always 4 adjustments on tax. The tax on foreign profit, capital allowance, tax on home profit, and additional tax. Okay, and now I can close the cash flow now. Yep, I can close the cash flow now. Okay. So this equals to the sum of, okay, I can start from here until here. Okay, then I just copy this and I paste here from the profit all the way down. Yep. Okay, then I need to convert, so I put in the exchange rate now. Okay, the exchange rate is here, year 0 to year 5. Copy this, okay, year 0 to year 5 exchange rate. Okay, I put in here now. Okay, so convert to dollar. So peso first currency we divide. Okay, so equals to, I take this, yeah, divide by this. Okay, and same thing for all the years. So I copy this, paste. Yep. Okay, I don't want decimal. And finally, this is your net cash flow at the end now. Equals to the summation of from here double colon until here, right? All this. Okay, let's copy this, paste it to the other 5 here. Yep. Okay. Discount rate, the cost of capital 10%. Cost of capital for this risk is 10%. So 10% or 0.1. Yep. And therefore I can now get the MPV. So use the function equals MPV, open bracket, the rate, comma, discount from year 1 until year 5. Year 0 we don't discount. Yeah? Discount year 1 until year 5, then you add year 0 cash flow. That's the MPV. Okay, that's the MPV, which is negative 72. Yeah, $72,000. Okay, so that's the final answer. Done. Okay. Now, next part of the question. Calculate the overall project's value after taking into account the follow-on option. Okay. Number 2 now, I can just do it at the bottom here. Okay. Okay. The option to expand, call option, the follow-on option. Okay. To work out the option value, first we need the 5 determinant. PA, PE, yep, time, standard deviation, risk-free rate. Okay, we need these 5 determinant. Okay, the risk-free rate is 6%. Yep. The standard deviation is 30%. So risk-free rate 0.06 in decimal. Standard deviation 30%, 0.3 in decimal. Yeah. The time must be in year. So this is expansion. So when are you going to expand? When are you going to do the follow-on projects? It says here after 5 years. Yep. After 5 years. Okay, from year 5 onwards. Okay, from year 5 onwards. Okay, exercise price. It's the capital for the expansion that is $2 million. $2 million. 2 million, yeah? So I think if I use 1,000, I just put 2,000 here. Yeah? So I put all my value in 1,000 here. Okay. Okay. So the time, the time, I think we look at the information carefully. Not well structured in this question, because this is not official ACCA exam. This is question prepared by Kaplan. So I think it's not that well answered here. So the cash flow is, the investment is in 4 years time, not 5 years. Okay. The first project is 5 years. Yeah, but the investment is in 4 years time. By the way, it should continue after that, but doesn't matter. We just follow what they give here. So in 4 years time, so it should be 4 years, not 5 years. So before you actually end the first project, you start the second one. Yeah. Okay, doesn't matter. We just follow the question. Okay, PA. PA is the present value of the project's net cash flow excluding the capital. The present value of the project net cash flow excluding the capital, because capital is PE. Yeah, capital is separated as PE. Okay, the present value here. Okay, this follow-on projects 0.3 million after tax. No need to adjust tax, already after tax. 0.3 million each year perpetuity. So you're going to use perpetual annuity now. Yeah, perpetual annuity is A over R, right? Therefore, this is 0.3 million divided by the discount rate 10%. Okay, but this cash flow starts from year 5. Yeah, this cash flow starts from year 5 because your project starts in year 4, so it's 1 year later. So if this is cash flow year 5, the present value is year 4. Yeah, because the original formula is present value now is A1 divided R. So since the cash flow starts from year 5, the present value is year 4. Okay, so therefore, now this is 0.3 million or 300,000 divided by discount rate 0.1. Okay, and this gives you the present value in year 4. So I need to discount by year 4 factor to bring it to the value now, because PA is present value now. Yeah, PA is always present value now. So 10% year 4 is 0.683. Got it? 10% year 4 is 0.683. Yeah, so that gives me 2049. Okay, 2049. Yep. Then, okay, you put into the BSOP calculator, which you will have that in your exam. Yeah, you can get the core value. Okay, you can get the core value, the C value. C, yeah, the C value, the core value. Okay. Okay. Now, I don't have the calculator here with me, but I just have the answer here. I just go straight to the answer. Just open up the answer. You should have access to the answer as well. So the MPV is negative 71,000. Yeah, 71, 72, some rounding error. Okay, so the BSOP calculator will give me, okay, there you go. Yeah, this is the 5 determinant R, S, T, P, E, P, A. Yeah? So the core value is 0.7 million. Okay, 0.7 million. Okay, close this. So the total project's value is the basic MPV or APV plus the option value. Yep. Okay. The basic MPV is negative 72 or 71. Yeah. Okay, negative 72, so is 0.072. This is in thousand. Yeah. Okay, 0.072 million, 72,000. Okay, plus the option value is 0.7 million. Okay, so that will give me the total project value at 0.772 million. .7 minus 0.072, 0.628 million. 0.628 million. Positive. Okay, positive. Then you can discuss your answer already. So without this option to expand, the project is not financially worthwhile since the MPV is negative. With this option to expand, you create additional 0.7 million. Yeah, so then it becomes positive 0.628 million. Okay, that's how you explain. Okay, this question done. Right, this question done. Okay, now the next question. Let me just save this first, yeah. Okay, the second question which I want to discuss is the interest rate risk management question. So we look at number 3. Question number 3. Okay. Okay, question number 3. The following exhibits available on the left-hand side of the screen provide information relevant to the question, Bragg Company and future borrowing requirements. Market information, board discussion. This information should be used to answer the question requirement within your chosen response option. Exhibit 1. Bragg is a company based in Wilco. It is expecting to borrow $27 million on 1st September and repay it in 5 months' time on 1st January, on 31st January. Okay, so you want to borrow this money on 1st September, pay back in 5 months' time. So it's 5-month loan, yeah, 5 months loan. Vicoland has historically been a stable country over recent months. There has been a deep recession and a new government was elected into power last month general election. Consequently, the board of directors feel that the future is looking quite uncertain. Interest rate might rise by up to 0.5% over the next few months. Therefore, they are keen to hedge the interest rate risk that the company faces on the upcoming borrowing. The CEO wants to use interest rate futures, options over futures, options on futures, or collar. So these three instruments. It is now May 31st. The base rate of interest is 3.6%. Brad can borrow at base rate plus 30 basis points. 3 months dollar September futures, so 3 months maturity each contract size, quoted at 95.92. So this is the futures price now on 31st May. Yeah, 95.92 the futures price now. Options on these 3 months dollar futures, contract size 1 million. The strike price is the exercise price. You have call and put. Both of these strike price will be relevant when setting up the collar hedge, but for the option hedge, the CEO only want to consider 96. So they already tell you which one to use. 96. Okay. Settlement of both options and futures contracts at end of the month, you should assume basis diminishes to 0 at constant rate until maturity, time interval counted in month. The same assumption you see all the time. Yeah, every question have this. Okay. Although the CEO wants to use traded derivative products to hedge against the risk on this transaction, the CFO raised the possibility of over-the-counter product. Okay, that's some discussion in part B. Yeah. So I'm going to focus on part A. 3 hedging choices: futures, options, collar. Recommend hedging strategies for the $27 million borrowing. If interest rate increase by 0.5%. Yep. Okay, let's do this. Now, you don't have to use spreadsheets for this part, because most of it is just pure typing answer. Okay. You use spreadsheets for investment appraisal question, for mergers takeover question where you need the table. For risk management, you can just type in word processing. Okay. Here I'm going to just write down the answer. Okay. $27 million. Yep. For 5 months. Okay. Number 1, using interest rate futures. Okay. First instrument is futures. Start from now. The date now is 31st May. Yep, 31st May. Okay. Here, 1, 2, 3, 4. Yes. These are all the standard presentation. Yeah. Tick value. Okay, these are all standard presentation. Yeah? Okay. So interest rate futures. First, we must decide buy or sell futures. Borrow, sell. Yep. Borrow money, sell futures now. Deposit money, buy futures now. The reasoning mechanism I already explained in the class. Maturity period, they only give us September, so it must be this. Yeah, September. Okay. The futures price now 95.92. Okay. Okay. Number of contract, I want to protect 27 million loan. I divide by the contract size, which is 1 million. 1 million. Then time proportion. Loan is 5 months. Loan is 5 months. Each contract is 3 months. Okay. That is 45. Yep. Okay. Tick value is the value of one contract affected by the smallest movement in the futures price. So 0.01% per annum, that's tick value. Yep, 0.01% because the futures price is 2 decimal. Okay, 0.01% per annum times by contract size, $1 million. One contract is 3 months. Okay. That gives me 25. Yep. Okay. You borrow money on September 1st. The base rate or the interbank offer rate increases by 0.5%. Yeah, that's what they want you to do. Increase 0.5%. Okay. Increases by 0.5%. Only one outcome, just increase. Okay, normally you will need to do 2 outcomes, one increase, 1 decrease normally, but here only 1. So, okay, cash transaction. futures transaction. Okay. Okay, cash transaction first. You borrow money, you must pay interest costs. Okay. So we want to work out what will be the interest cost when you borrow on 1st September. Okay. The base rate now is the base rate now is 3.6. Yep. You can borrow at base plus 30 basis point or 0.3%. So the base rate now is 3.6%. Base rate increased by 0.5, so it becomes 4.1. You can borrow at base plus 0.3, so it becomes 4.4. Final interest rate here, 4.4. Okay. The loan is 27 million. The loan is for 5 months, so 5 over 12. Yeah. So the interest cost $495,000. Okay, 495,000. Okay, the futures transaction. Now we are selling borrow money. Yeah, now we are selling at the price of 95.92. To close is always offsetting. So if we sell now, we must buy back later. Okay. Now, we need to predict the futures price on 1st September. We use basis risk, right? So we create a working for that. We use basis risk. Okay. Using the same assumption that we do all the while. So assuming basis risk decreases linearly upon maturity, now is May 31st, yes? Now is May 31st. Borrow money is 1st September. Contract maturity, this is September contract. So we assume maturity end of the month, September 30th. Yeah, we assume maturity end of the month. Okay. Basis rate is the difference between futures price and the interbank offer rate. Okay. Futures price now 95.92. Yep. Futures price now. Basis, the interbank base rate now is 3.6%. Okay, interbank base rate now is 3.6%. I must take 100 minus 3.6. That's 96.4. Yep. 100 minus 3.6. So that will give me basis of 0.48. Okay. from here to here. June, July, August, 3 months. Yep, 3 months. From here to here is 1 month. Okay. Basis will become 0 here. Yep. Okay. Now, the basis left over on 1st September, left over is 1 month. The whole thing is 4 months. Okay, balance 1 month. The whole thing is 3 plus 1, 4 months. That will give me 0.12, right? Okay. The interbank rate from 3.6% at 0.5, 4.1%. So 100 minus 4.1 is 95.9. Yep. And I can now find the futures price. Okay, 95.9 minus 0.12, 95.78. Okay, 95.9 minus 0.12, 95.78. This is the futures price we have predicted. Okay. So selling price higher than buying price, we make profit. Okay, we make profit. $0.14. Okay, which is 14 ticks. 1 tick is 0.01. Yeah. Okay, 14 ticks. Each tick is $25 per contract. We have 45 contracts. So that will give me my total profit. Okay, so therefore, finally, the net interest cost. Okay, the net interest cost, 495,000 interest cost minus the profit 15,750, that is 479, 250. Okay, the interest cost minus the profit. This is futures. First instrument done. Okay. The next instrument, options. Okay. Interest rate options or options on futures. September 1. Okay, this format are standard. Okay, So options for borrowing, you will buy put. Yeah, because borrow, we're going to sell futures. So we want the right to sell futures, that's put. Okay, the right to sell is put. Maturity is September. Exercise price has been chosen for you, 96. Okay, 96. Okay, they have chosen for you the exercise price, 96. How to choose, I already explained in the class, so you follow that mechanism. But here they've chosen for you. Okay, the rest will be the same because it's same contract size, 1 million. Yeah, also 3 months. So the rest will be the same. 45 contract, tick value $25. Okay. Interest rate increases by 0.5%. Okay, the interest cost same as just now, 495,000. Yep, 495,000. Options transaction now later. Okay, now we buy put option. Now we buy put. Okay, now we buy put. Put option give us the right to sell the futures at the exercise price 96. Okay, so in the case option, we only fix one side of the transaction. Put option, we fix the selling price. The buying price will follow the market price, which we have predicted just now. The market price for the futures, okay, which is 95.78. 95.78. So put, we fix the selling price. Call, we fix the buying price. Yeah, remember that. Put, we fix the selling price. Call, we fix the buying price. Okay, now option, we can choose whether to exercise or not. So here selling price is higher than buying price, so we exercise, yeah, because we will make profit. Okay, selling price higher, we will make profit. Okay, and with this profit, don't forget, you have a premium. Okay, you have already paid a premium cost so that you can decide to exercise or not. So make sure you net off the premium cost. Okay. Premium cost 96. September put 0.46. These are annual percentage. Okay, the premium. So 96 price, 96 exercise price. September put 0.46. Yep. So you end up with a net loss here. Okay. 24 ticks. Every tick is $25 per contract. We have 45 contracts. loss. Okay, so your net interest cost $495,000 plus the loss 27,000, that is 522. Okay, 522. Yep. Okay. Okay, the last one is caller. Okay, last one, caller. So caller is at the same time you have a pair of put and call option. Yeah, you buy one, you sell the other one. Both with the same maturity period but different exercise price. Okay, so caller is at the same time or simultaneously buy and sell a pair of call and put option of the same maturity period but different exercise price. The objective is the premium that you earn from selling options will be used to offset the premium cost of buying option. So that will reduce your hedging cost. It can reduce your premium cost. Okay. Now, we have already decided on the put option. We will buy put. Yep. Maturity September, exercise price 96. Okay. So we will buy put 45 contracts. Therefore, we will sell call. Okay, we buy put, sell call. With the same maturity period, but at different exercise price. Yeah, you cannot have buying and selling the same thing same time. There's no logic. So at least one aspect must be different. So for caller will be at different exercise price. So just now you take 96, now you take 95.8. Okay, 95.8. Okay, yeah, the rest are similar now. 495,000. This is same as just now. $495,000, yeah. Okay, 495,000 same, yeah. Right, comes to the option. Okay, you have two options now. Okay, the first option is you buy put, yeah. The second option is you sell call. Okay. On the buy put option, we already decided just now we will exercise because we profit 0.22. Okay, so we will exercise profit 0.22. Okay, we need to decide on the call now. Okay, we decide on the call. Call option, we will fix the buying price at the exercise price 95.8. Correct? Call, we will fix the buying price. So the selling price will follow the market futures price on September 1st. Our prediction is 95.78. Yeah, 95.78. Okay, in this case, selling price is lower. So if you exercise is loss, selling price is lower. So you will not exercise. Okay. So you don't have loss. Yeah, selling price is lower. So since you don't exercise, you don't have loss. Okay. Next, the option premium will come in. When we buy option, we must pay premium of 40.46. Okay. You buy this one, right? 96, right? So 0.46. Okay. So when you buy option, your premium is 0.46 percentage. This is cost because you are buying. Okay. When you sell option, you are receiving premium income. So the call premium income is 95.8. Call is 0.43. Okay, 0.43. So your net premium cost become very much lower now. Yep. Okay. So 1, 2, 3 separate transactions. You combine these three together. Okay. So 0.22 minus 0.03 is 0.19. Okay. Done. 0.19. That's 19 ticks. One tick is $25 per contract. We have 45 pairs of contract. Yeah, 45 pairs of contract. Okay, that's your total profit. So 495,000, okay, minus 21375. Four seven three six two five. Okay. 473625. That's it. So now we can compare and decide now. Okay, so if you compare the three hedging techniques now, futures interest cost 479,250. 522 and 473625. Yeah, 625 473 479. So 473 seems to be the lowest. Yeah, so since it's interest cost, we pick the lowest. So callers is the lowest. Okay. Okay, that finished the second question. So one question on investment appraisal, in this case is question 1. One question on risk management, yeah, in this case is interest rate risk. So the third question is always mergers, takeover or divestment. Okay, I quickly run through the third questions. Yeah, so that one you can just look at the answer by yourself. I just quickly run through. So this is the third question. Okay, I just run through. Yeah, so you have done the mock. Yeah, then you can check the answer. Okay, this company is in food retailer, but want to diversify into furniture. Okay. Okay, so you have some information on this. Yeah. Okay. They give you the valuation of the furniture business. So you diversify to furniture. Yeah, you want to buy over this furniture. So the current free cash flow valuation for the furniture business using weighted average cost of capital 10%. On the assumption the cash flow will grow at 1% per year to perpetuity, this is the valuation using free cash flow model. Okay, then you got other information here. Yeah. Okay. Calculate the expected sales price of the furniture business and demonstrate its impact on Grindr statement of financial position, forecast earnings per share, and the weighted average cost of capital. Yeah. So a lot of this is just accounting. Yeah. So revise the statement of financial position, the EPS, okay, and then you evaluate. Now, so okay, if I just show you from the answer here briefly, just briefly. Okay. The second question. So, proceeds from the sales of the furniture business, the free cash flow valuation 347.6, that's given just now. Yeah. The expected sales price at 10% premium, because they tell you in the question, is 10% premium on sales. Okay, they tell you that, 10% premium on sales. There. Okay. Then impact on the statement of financial position, you can go through this by yourself. Yeah, some accounting adjustment only. Don't worry about the double entry. The journal entry, no need. It's not required actually. They just want this. Okay, they just want this. So some accounting adjustment, journal entry, just ignore that. So statement of financial position, earnings per share, right? Okay. The impact on review ACC with the normal beta adjustment. These are quite basic. Okay, so the beta, all this information given, the normal beta adjustment. Okay, so not difficult. So apart from some accounting adjustment, okay. So this part is basic, just 10% premium. So this is just some accounting adjustment, and then the review ACC is also basic beta adjustment. That's all. Okay, so with that, I will end the review for this mock. Okay. So if you have passed this mock, then well, you are quite well prepared. If your pass mark is 70, 80, then you should be very safe. If your pass mark is just 50 to 60, then you still got to do more effort, practice more question. Okay, if you fear this more, that means your knowledge is not there, but this question actually is not difficult. Then you got to go and brush up more. Revise more on your knowledge. Okay. Okay, that's it for this. Bye bye and good luck.